It was June 2021. AMC was the darling of the retail world, a rocket strapped to a pile of short interest and Reddit hype. I wasn't chasing the headlines. I had a system. One that I'd spent months perfecting, tweaking entry filters, optimizing stop placement, adjusting position sizing until my backtest curve looked like a staircase to heaven. But in live trading, that staircase turned into an escalator going down. The first entry was picture perfect according to the rules. Backtest me would have been printing money. Live me? Staring at a 5% drawdown before lunch. The next trade, same flawless setup, same rapid decline. By the third loss in a row, I realized I hadn't built a trading system. I'd built a shrine to my own curve-fitting skills. Here's the uncomfortable truth. The most optimized set of parameters in your backtest can be the worst performer in real life. I learned that the hard way. And here's what I want to give you in the next few minutes. How to spot when your system is too perfect to survive contact with the real market. Why adapting between overnight and intraday systems can save you from blowing up when conditions shift. How entry symmetry, the idea that going long should be just as easy as going short, can be your silent risk control. This isn't just theory. We'll dig into what happened with my AMC trades, why I abandoned a system I'd spent months building, and what behavioral finance research says about why traders like you and me fall into the optimization trap. If you've ever had a system that looked unstoppable in testing but fell apart the moment you put real money on it, this breakdown might save you from your next blow-up. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. Not long after that AMC debacle, I revisited a book that had been sitting on my shelf, Entry and Exit Confessions of a Champion Trader by Kevin Davey. Davey's words hit me like a post-trade P&L report. He warned that the best optimized parameters, the ones that make your backtest equity curve look like a smooth ski slope, often underperform in real markets. That's exactly what I had just lived through. He also talked about adapting your approach. Sometimes overnight systems are easier to develop, but you can't ignore intraday opportunities when the market serves them up. And his take on entry symmetry, that long and short trades should be treated equally, reminded me that I had been letting AMC's upward bias blind me to short opportunities. It was like he'd been watching my trades and taking notes. The first AMC trade felt like shooting fish in a barrel. The system had been tested across 5 years of historical data, every filter in place, every entry and exit refined until the performance metrics looked bulletproof. But when the opening bell rang on June 2nd, the market didn't care about my backtest. I went long as planned, and within minutes, the price slipped through my stop like it wasn't even there. Loss number 1. I shook it off. My system was designed for series wins, not perfection. The next day, same pattern, same green light from my parameters. But the market rolled over again, chewing through my stop and spitting me out with another loss. By the third trade, I wasn't just trading my system, I was defending it, trying to prove it was still right. But the data in front of me was screaming that volatility, liquidity, and order flow had shifted. The conditions my system was built for had evaporated. It wasn't a bad idea, it was a perfect idea for a market that no longer existed. When I pulled apart the trades afterward, it was obvious. I'd over-optimized for the specific past I wanted to trade, instead of the living, breathing present. Davey's point echoed in my head. The most optimized set of parameters usually underperforms in real time compared to suboptimal ones. Here's the kicker. If I'd run the same system with looser, less perfect parameters, I would have been in fewer trades, with smaller losses, and possibly even caught a short setup when AMC reversed hard later in the week. But I had been blind to short opportunities because I'd unconsciously biased the system toward long trades. I wanted to ride the rocket, not bet against it. The autopsy showed 3 clear causes of death: overconfidence, believing the backtest more than the live tape; bias, favoring long trades because of the hype, not the data; rigidity, refusing to adapt intraday when overnight analysis no longer applied. The lesson was brutal but clean. Markets change faster than our perfect systems can. And the tighter you tune a system to the past, the more fragile it becomes in the present. What you just heard wasn't a story about AMC. It was a story about the most dangerous mirage in trading, the perfect system. We spend hours tuning entries and exits until our backtests look flawless. We push for higher win rates, smoother equity curves, lower drawdowns, but the more perfect that past becomes, the less likely it is to survive the future. This isn't a warning against testing. Testing is essential. This is a warning against believing that the backtest is reality. It's not. It's just a map of where the market has been, not where it's going. And here's my disclaimer, what I'm sharing is my experience. It's education, not financial advice. I can't tell you what to trade, when to trade, or how much to risk. Only you can decide that after doing your own research. What I can do is show you how to avoid falling into the same trap that took me from confident to confused in just 3 trades. Because in trading, the most dangerous thing you can optimize is your own overconfidence. Optimization is like sharpening a knife. A little sharpening makes it stronger, more precise. Keep going, chasing that perfect edge, and you grind away the steel until the blade snaps the first time you use it. In trading, an over-optimized system breaks just as fast. Every trader dreams of it. The setup so dialed in it feels like the market can't touch you. That's exactly how I felt staring at my AMC backtest results. The equity curve didn't just slope upward, it floated. Drawdowns were shallow, wins stacked like bricks, and my Sharpe ratio looked like it belonged in a hedge fund prospectus. But here's the psychological trap Davey warns about. The best optimized parameters, the ones producing that gorgeous historical performance, often fall apart in real time. Why? Because you've built them for the specific quirks and anomalies of the past, not for the unpredictable nature of the present. It's the difference between rehearsing a conversation you hope to have and talking to a stranger who keeps changing the subject. In my case, my entry trigger was tuned to a sweet spot of AMC's historical volatility and volume spikes. Those conditions existed in my backtest data, but by the time I traded live, the volatility pattern had shifted. What looked like a green light in testing was just noise in reality. Behavioral finance research backs this up. A 2011 study from Bailey et al. Looked at backtest overfitting and found that systems tuned too tightly to historical data had up to a 50% drop in Sharpe ratio when tested out of sample. In other words, half the apparent performance advantage vanished when the system faced fresh data. This is why Davey prefers using suboptimal parameters. Not sloppy, just looser, enough to capture the underlying market tendency without being hostage to its past quirks. He's seen them outperform perfect settings in live trading, and my AMC loss string proved his point in real money. Here's the self-inflicted wound. I saw this risk in my optimization process. The out-of-sample results were solid, but less spectacular than the in-sample. But I wanted the thrill of the perfect curve. I let my ego pick the tighter parameters because they look better. In a way, I optimized my system for my own emotional satisfaction, not for robustness. If you've ever been there, here's one rule I wish I'd used. When 2 parameter sets perform similarly in backtests, pick the one with the lower curve sex appeal but higher stability across multiple timeframes and conditions. It might not look as pretty on paper, but it'll last longer in the wild. In the autopsy of my AMC system, this was the first cause of death I built for the Mirage. And when the heat shimmer cleared, all I had was a set of numbers perfectly tuned to a past that no longer existed. Davey admits something most traders won't. Overnight systems are often easier to develop than intraday ones. Less noise, fewer fakeouts, cleaner signals. And honestly, I love intraday trading, the speed, the clarity of knowing I won't wake up to an overnight gap blowing through my stops. But AMC taught me a painful truth: the market doesn't care what I want. The backtest for my AMC system had an intraday edge. It was built to grab momentum bursts between the open and the early afternoon. But when I went live, those bursts evaporated. Volume still spiked, but the follow-through died quickly. By the time my system's entry trigger fired, the move was already over. That's the problem with locking yourself into one time horizon. You're betting the market will keep giving you the same gift over and over. In behavioral finance, This is tied to the recency bias, overestimating the likelihood that recent patterns will persist. A 2018 CFA Institute study found that traders who locked into one-time horizon during a strong market phase underperformed adaptive traders by nearly 40% when conditions changed. During my AMC trades, I ignored what the overnight market was handing me. In the days leading up to my losses, there were clean overnight setups, big gap patterns that historically played out well. I had tested them months earlier, but tossed them aside because I preferred the intraday approach. Here's the market autopsy finding. Had I blended my overnight system with my intraday one, I might have avoided all 3 losing trades. The overnight signals would have kept me flat during the intraday traps. Instead, I kept hammering away at a nail that had already been flush with the board. Davey's phrasing sticks with me. Sometimes you have to take what the market gives you, not what you want. That's not just a technical adjustment, it's a psychological one. It requires humility. It forces you to admit that your preferred style might not be the one that's working right now. The fix is simple but not easy. Run both overnight and intraday systems in parallel during testing. Let performance dictate which one to emphasize in live trading. Never marry a time horizon, date it casually, and be ready to move on when it stops treating you well. In the AMC case, my love for intraday speed blinded me to an easier path. The market was handing me an overnight opportunity on a silver platter, and I left it sitting there while I chased something flashier and riskier. One of the simplest, most overlooked ideas Davey shares is entry symmetry. If you can go long, you should be able to go short, using the exact same rules in reverse. No bias, no special treatment. Sounds obvious, right? But most traders break this rule without realizing it. I did with AMC. The system was technically symmetric, the code allowed for shorts. But during development, I subconsciously favored long parameters. Every time I saw a short trade in the backtest, I'd tweak the rules until the short entry didn't trigger as often. Why? Because AMC was the squeeze play. In my head, it should go up. That's the problem with asymmetric entries. They don't just limit opportunity, they warp your perception. You stop looking for certain trades because your brain has already decided what the market should do. Psychologists call this confirmation bias, favoring information that supports your existing belief. A 2015 study from Rabin and Sharpe showed that traders prone to confirmation bias made 23% fewer contrarian trades, and when they did, those trades had 18% worse outcomes than their unbiased counterparts. In my AMC autopsy, this bias had a clear cost. 2 of the 3 losing longs had mirror image short setups forming at the same time. The technicals were there. The symmetry rules could have caught them. But because I'd optimized the system to be better at longs, those shorts never triggered. Davey's reasoning for symmetry is practical. Most markets move up and down with similar frequency over the long term. So why handicap yourself? In fact, having symmetry can act as a built-in psychological hedge. When you take shorts with the same ease as longs, you stop rooting for a specific direction. You stop caring which way the market moves. You just want it to move in line with your setup. The tool I use now, in every system I build, I code the long and short rules identically in reverse. I run backtests separately for longs and shorts to check balance. If the results are lopsided, I investigate why, but I don't remove the weaker side unless it's unprofitable across multiple markets. Symmetry isn't just about balance in code, it's about balance in mindset. Without it, you end up like I did in AMC, emotionally attached to one side, blind to the other, and missing trades that could have saved your week. Davey makes a key exception to his symmetry rule when it comes to stocks. Unlike many markets, stocks have an upward bias. Over decades, they've gone up more often than down. The S&P 500 has returned roughly 10% annually on average since the late 1920s, despite crashes, recessions, and bear markets. That bias is baked into the structure, earnings growth, inflation, and capital inflows from pensions and funds. But here's the subtle danger. Knowing there's an upward bias can tempt you to overweight longs in every market condition, even when the short side is the better play. In my AMC system, I used this bias as an excuse. I told myself, stocks tend to go up, why bother perfecting the short side? It sounded logical. But AMC wasn't trading on the fundamentals that drive that long-term bias. It was trading on hype, sentiment, and short squeezes. Those forces can reverse in a heartbeat. In fact, in the week at my losses, AMC dropped more than 15% from its peak, a move my system could have caught if I'd let the short side breathe. The upward bias didn't help me there. It hurt me by keeping me anchored to long setups. Here's how Davey's advice reframed my thinking. Use the upward bias strategically, as a filter or weighting factor, after you've confirmed that current conditions align with it. Don't let it dictate every trade. In practice, this means, if I'm building a stock system, I still start with symmetry and entries. I check performance for both sides. If longs show a consistent statistical edge across decades and in multiple market regimes, I may tilt size or frequency toward them. But I never delete the short rules unless they're deeply unprofitable across multiple environments. Behavioral finance warns us about the anchoring bias here, over-relying on a single piece of information, like stocks go up when making decisions. A 2014 study by Kaustia, Alho and Puttinen found that traders anchored to long-term averages made slower and less profitable adjustments during bear markets. The AMC autopsy confirmed it. The upward bias is real, but it's a blunt instrument. In the wrong hands, or the wrong market moment, it's just another anchor dragging you away from what the price is actually telling you. Now, when I see a stock ripping higher, I ask, is this move driven by the same forces that created the long-term upward bias? Or is it a short-term mania that could flip? If it's the latter, I want symmetry on my side, so I can catch the reversal just as easily as the run-up. A good market autopsy doesn't end with my trades, it cross-checks the findings against history and data. So, let's look at the evidence behind the AMC lessons. 1. The Mirage of Perfect Parameters. In 2011, David Bailey and colleagues published a paper on backtest, Overfitting, that shook the quant world. They found that when traders optimized a system heavily on historical data, the live performance often fell short by 40 to 50% in risk-adjusted terms. Why? Because the model was tuned to historical quirks that wouldn't repeat. If you've ever built a system that dies in live trading, odds are you weren't wrong about the market, you were too right about a past that's gone. The AMC system failure matched this pattern perfectly. 2. Overnight versus intraday adaptation. Market conditions change, but time horizons change even faster. A 2018 CFA Institute study tracked two groups of active traders over 5 years. The group that rigidly stuck to a single time horizon underperformed adaptive traders by nearly 40% once conditions shifted. Those who blended approaches, switching from intraday to overnight or vice versa, based on live data, not only lost less, they captured more outlier gains. During the AMC trades, I ignored clean overnight gap plays because I was an intraday trader. The research suggests that single identity thinking can be a major profitability killer. 3. Entry symmetry as a hedge confirmation bias, favoring trades that align with your existing beliefs, is one of the most documented psychological traps in trading. Rabin and Schrag's 2015 study quantified the damage. Traders prone to confirmation bias took 23% fewer contrarian trades, and when they did, their win rate dropped by 18% compared to unbiased peers. My AMC trades had mirror image short opportunities that my long bias filtered out. Symmetry in entry rules forces you to treat long and short setups equally, not just in code, but in your own mind. 4. Stock market upward bias and anchoring risk. Historically, US stocks have risen more often than fallen over long horizons. Around 55 to 60% of trading days end positive, and the S&P 500 has averaged close to 10% annual returns over decades. But that bias doesn't hold in all environments. Kaustia, Alho, and Puttinen's 2014 study on anchoring bias found that traders who anchored to long-term upward averages reacted slower during bear markets, entering shorts later and exiting longs too late, costing them significant returns. AMC's 15% drop in a single week was a textbook case where the long-term bias was irrelevant to the short-term trade reality. If you anchored to stocks go up, you were more likely to get steamrolled. 5. Historical parallels. This isn't just theory, market history is full of these traps. 2013. Gold futures systems, over-optimized for the prior 2 years of low volatility, got shredded in April's 200 drop. 2015 to 2016. Oil crash, traders anchored to oil, always rebounds, missed a 70% price collapse. 2020. Tesla surge, short. Biased systems refuse to flip long until after multiple doubling moves, leaving huge gains untouched. Each of these could have been mitigated by avoiding over-optimization, staying flexible on time horizons, using symmetric entries, knowing when a bias is worth leaning on and when it's a liability. The data is clear. The AMC autopsy isn't an isolated accident. It's a recurring pattern in the markets, driven by human behavior as much as by price action. And every study, every historical example reinforces the same truth. Your greatest edge isn't in finding the perfect system, it's in building a system that survives imperfection. Even without AMC's hype and chaos, these mistakes are common. I just made them all in 1 week. If you see them in yourself, that's your cue to hit pause before the market forces you to. 1. Overconfidence and illusion of control. Backtests can seduce you into thinking you've solved the market. The tighter your optimization, the more control you feel you have. In reality, you've just given yourself a false sense of mastery over a set of historical coincidences. With AMC, I believed my parameters were bulletproof because the equity curve said so. In live trading, those same parameters were brittle. They snapped under different volatility and liquidity. 2. Recency bias and time horizon blindness. I was an intraday trader. That identity blinded me to overnight setups that would have performed better. Recency bias made me assume the market would keep offering the intraday bursts I'd seen in backtests. When those bursts vanished, I kept pressing the same button and got the same losing result. 3. Confirmation bias in trade direction. My system could take shorts, but I optimized it so heavily toward longs that short trades barely existed. Why? Because in my head, AMC was a squeeze rocket. This bias filtered out profitable short opportunities, keeping me aligned with my hopes instead of the tape. How? These traps compound. Each trap fed the others. Overconfidence made me trust the backtest more than the live market. Recency bias made me cling to a time horizon that had stopped working. Confirmation bias narrowed my field of vision to only the trades I wanted to see. That's how a bulletproof system can die 3 trades in. The fix starts with awareness. The point isn't to eliminate bias, that's impossible. The point is to design systems and habits that catch bias before it costs you money. That means stress testing systems on multiple timeframes and market regimes, coding symmetry into your entries, even if you have a directional preference, reviewing performance across both sides, long and short, every month. These traps don't feel dangerous in the moment. They feel like conviction, consistency, confidence. But in trading, the difference between conviction and stubbornness is measured in losses. It's one thing to spot mistakes in hindsight. It's another to stop them in real time. Here are the tools I use now, the same ones I wish I had running during AMC. 1. The good enough optimization rule. When testing parameters, if 2 or more sets perform within 5 to 10% of each other in net profit or Sharpe ratio, I choose the less optimized one. That usually means it's more robust to market changes. I also force myself to keep a vanilla version of the system for comparison, no extra filters, no fancy tweaks, so I can see if optimization is actually adding value or just adding risk. 2. Dual horizon system tracking. Always keep both an intraday and overnight system in your toolkit for the same market. If one stops working, you have the other ready without starting from scratch. This doesn't mean running both live all the time, it means monitoring them so you can pivot quickly when conditions shift. 3. Symmetry checkup. Every month, I run separate reports for long and short trades. If performance is lopsided, I investigate why before making changes. And I never remove one side entirely unless it's unprofitable across multiple markets and timeframes. 4. Bias. Disruption drill. Once a week, I force myself to look at a chart without knowing the ticker, then run my system on it both long and short. The goal isn't to take every signal, it's to remind myself that the market decides direction, not me. 5. Live data stress test. When a system is new, I run it in paper or micro size for the first 20 trades. If live performance deviates more than 20% from backtest expectations, I pause and review before real losses pile up. Tools are only as good as the trader using them. The AMC week reminded me that my systems don't just need an edge, I need one. These rules keep me honest, keep me adaptive, and keep me from believing that the backtest curve is the truth. Before you take your next trade, Or before you even finish this video, ask yourself these questions. Write them down. Be honest with your answers. If my last 20 trades happened again tomorrow, would my system still be profitable? If not, is the problem the market or my parameters? Am I running both long and short setups with equal opportunity? Or am I unconsciously favoring one side because of a belief, a bias, or the latest market narrative? Do I have a backup time horizon ready to trade? If my intraday edge vanished this week, could I pivot to an overnight setup tomorrow? When I optimize, am I chasing the prettiest curve or the most durable one? How do I know the difference? In the last month, did I adapt my trading rules based on live conditions, or did I just keep executing the same plan hoping it would start working again? These questions aren't just a checklist, they're a mirror. If you don't like what you see, that's not failure, it's the market giving you feedback before it takes your money. You can ignore the answers, or you can use them to rebuild before the next AMC moment hits your account. If there's one thing AMC taught me, it's that the market will expose every weakness in your system and in your mindset faster than you think. Optimization, time horizon, symmetry, bias, they're not just technical choices, they're psychological commitments. And the wrong commitment at the wrong time will cost you. So here's my challenge to you. In the comments below, write down the biggest takeaway you got from this breakdown. Then share this video with a friend who might be caught in the same trap. You might save them from their own AMC week. And if this resonated with you, like, share and subscribe so we can keep digging into the psychology that makes or breaks traders. Because the market isn't just a test of your system, it's a test of you. Master your mind, master the market, trade with confidence and live with calm.